All right. Hey, what's up, everyone? This is Kirk here again at Option Alpha. So thank you so much for joining me today back on the show here at Tradier. So I wanted to go through some stuff today. We're going to be going over in this particular show some new research that we did on SPX overnight ranges. So you might recall that we did on the last show, we kind of walked through some new research that we had published for our members on peg data, what we're calling peg data, which basically the SPX likely pegging range within like a certain tolerance or variance by the end of the trading day. And so today what we're going to do is we're going to go over this new research that we published, which is on SPX overnight ranges. And we're also going to share a bot template, how you can use that bot template. I'll clone it, kind of make a couple of tweaks and adjustments, but kind of walk you through kind of the process with it. So again, the goal here is if you are interested in trading some things that are overnight, like 1 day to expiration or 0 day to expiration, hopefully this data gives you a lot more confidence. I know it does for me personally because I use it in my own personal trades to just give me a little bit more confidence on the types of positions I get into or how I start to structure my positions. And then, of course, if you're using bots and automations at Option Alpha, then it makes it easier to implement this. You don't have to go in and do this every single day or remember to do it every single day. You can just have a bot take care of it for you. So let's jump on over and we're going to share my screen here, guys, and get the tabs up. Okay, so the first thing that we're going to look at here, I'll kind of back up here so you guys can see me on the screen. So the first thing that we're going to look at is we're going to look at the, if you might recall, this is the old peg data that we had before. So this was SPX 0 days to expiration. So the same day we ran this data on minute level data. And basically it was showing you the ranges that SPX could be in by certain times of the day. So for example, at 10:30 a.m., it was 20%. There was a 20% chance that SPX was within 0.1% of its closing price. So if you opened a position that was 0.1% away from the market at 10:30, by the end of the closing day, the market was 0.1% away from its closing price 20% of the time. So you go to the opposite end of the spectrum here, you can see that there's a 93% chance that if you open a position or that the market price at 3:30 was within 0.5% of the closing price of the day. So you can see in all of those cases there's really good data that we can basically build on top of. And so what I did last time is I showed you that you can use this peg data in conjunction with just a quick reward risk ratio. And just you can see exactly how much you need to take in for each level of potential probability of profit, basically each peg zone. So if you're looking at something that had, say, just over a 50% probability of pegging, like at 11 o'clock, there's a 55% chance that the market will be within 0.3% of its 11 o'clock price by the end of the day. So that's tradable information. If you open a position at 11 o'clock, the day of expiration on a 0 DTE contract, you've got about a 55% chance of winning on that position if that position is 0.3% out of the money. That's good information. So it's better than a coin flip. So if we take this information and then we can say down here, okay, if I've got a 55% probability of success somewhere in this range here, then that means that in order to make this trade, in order to make any trade, I need to be somewhere around 100% reward to risk ratio. And that means I'll be collecting enough money to actually make the trade make sense. So that's kind of the concept around using this peg data. The same thing can be broadly applied now to our overnight research that we did. So if we jump on over to OA Labs, which I think this should be showing now. Okay, good. So if you go over to OA Labs, this is totally free and available. We update it every single day. You can come in every single day if you want to and grab the newest Excel file. But down here in the bottom right is this section called research data. And in research data, we have all types of different research that we've published, liquidity data. This is the peg data that I just talked about that's updated every single day. And then the latest file down here is our SPX overnight range. Now this works a little bit different than the peg data because now what we're doing is we're taking specific times of the day and then running the analysis for the next trading day. So if you opened a position at 10 o'clock today, and then you looked at it at 10 o'clock the next day, what would it be? Or if you open a position at 2 o'clock today, and then looked at it at 2 o'clock the next day, what would you get for that position? What would be some of the numbers? And so the reason this one's is potentially kind of fun is because sometimes pricing isn't too favorable for a 0DTE trade. It's not like every day there's a perfect trade available. And so that means that sometimes you might want to trade a 1 day to expiration trade, or you might be interested in trading a 1 day to expiration trade so you can get away from any pattern day trading restrictions that you might have. So if you enter a position today, even if you enter right before the end of the close today, and then you get out of the position tomorrow, it doesn't count as a day trade because you didn't enter and exit the same trade in the same day. So by doing trades 1 day to expiration, like a 1 DTE, you actually get out of that pattern day trading restriction. You can get out of trades earlier if you want to. You don't have to let them go to expiration. Again, this would only be if you have accounts generally under $25,000. You have this restriction that you have to not be hit with these PDT rules, okay? So if you click here anytime when you're inside of Option Alpha and OA Labs, it will download the actual Excel file. So let me jump on over to the Excel file here. I think, guys, I have to share a different screen here. So let me share this screen for you. I totally told you guys the wrong thing in the beginning where I said I was only going to share one screen. So here's the other screen there. It's a Excel file. Okay, good. Thanks, Luis. So here's what the Excel file looks like. I zoomed in because I have terrible eyesight, but if you zoom out, you can see it's got all the data in here up in the top row, and then you just zoom in and do whatever you want to do with it, obviously. But what I'm going to show you here is basically the data for the next day or the overnight range. So let's start in the top left here. This is the very, very top left of the Excel file. So this column here, this is the opening time. So this would be if you open a position today, then what would the data be the next day at a certain time? So if I looked at, let's say, this one right here, let me just kind of highlight this one here. This is, for those of you who are following along, it's cell E8. This would say if I open a position at 1 o'clock today, and then I held that position till, or just not held that position, but I just watched the market from 1 o'clock today to the next day at 10 o'clock. This is what this category, this block here is looking at. If I looked at the market price the next day at 10 a.m., so mark the market price at 1 o'clock today, then check back and look at the market price at 10 a.m. the next day, then I would find that 58% of the time, the S&P price stayed within $20 of the 1 p.m. price yesterday. So again, 58% of the time, the S&P stayed within $20 of yesterday's 1 p.m. price. 61% of the time, the S&P stayed within $20 of yesterday's 3:30 price. So this is, again, very helpful information because if you know this information now, and again, we update this every single day going back 180 days. If you know this information, or more than 180 days, 230 days, if you know this information, you can now build trading strategies off this. You can use this information to leverage any statistical edge that you might get versus otherwise just kind of guessing and picking and choosing, right? So here's what we can do. If you look at this data here, this is the 10 a.m. range. If you scroll over to the right, you'll see all the different ranges. They're basically grouped in about hour increments. So you've got the 11 a.m. range. You've got the 12 o'clock range. So if we go over a little bit more, oh, it's not scrolling there. There we go. You got the 12 o'clock range. You've got the 1 o'clock range, et cetera, all the way to the end of the day. Now, what you will notice is that generally speaking, as you go out in range, right, as you go out in time, you're giving the market more time to move. So it makes the most sense that some of the highest numbers are going to be from 3:30 one day till 10 a.m. the next day. So basically an hour's worth of trading. That hour's worth of trading is going to have some of the highest numbers across the board. So if you can make trades in a shorter period of time, then you obviously have higher likelihoods of success. But that doesn't mean that you're going to get a lot of decay that quickly either. It doesn't mean that you're going to get really, really fast time decay. In fact, we published research that shows that time decay really doesn't happen until kind of the end of the day on 0DTE contracts anyway. So you might not get the free lunch that you're looking for, but those are going to have the highest probability ranges naturally. Now, if you look at the Excel file further out in time, so if we go all the way out till, let's say, at the close, so this is basically from 3:30 or whatever time period you're looking at here on the left-hand side, any of these time periods, but let's just say 3:30. You're looking at 3:30 till the end of the next trading day, so actually a full trading day. You can see that these numbers are a little bit different. many cases they're much lower because now you're giving the market more time to move, right? You gave the market the entire time of the rest of that trading day, which is 30 minutes, but then the whole next trading day as well. Not to say that there aren't any bad things in here. It's just understanding that some of your higher numbers are going to come earlier in the day. This could be a case where if you look at this like how I do, it's like you definitely want to look at those early morning numbers just to see kind of generally how much the market moves in kind of that overnight or overnight range. But it probably doesn't hurt to look at these numbers also. Like this right now is very telling to me, which is that generally speaking, the market closes more than a coin flip of the time within $30 of any price the prior day. So it doesn't really matter what price you looked at yesterday. The market generally closes within $30 the next trading day. So if you can build strategies that are $30 out on either end and give you a pretty good credit or premium or whatever the case is, that might be a decent strategy. So that's how you can kind of look at this data. Again, it's updated all the time. It's very interesting data. The one that we'll kind of look at today, I think that one that we used in a template was something around here, about a $20 range or so. And we'll show you kind of how you can use it. But let's just look at this. This is the next trading day. This is the next trading day at 10 a.m. And again, this would be if you entered a position, let's call it, 12, 1 o'clock and after, you'd probably find yourself in a range where the market is, call it 58, 60% probability of landing within $20 the next morning at 10 a.m. Okay. So those are pretty good numbers. We can kind of work with those numbers. It means that better than a coin flip number of times, you're going to find that the market's going to land within $20 of whatever price it's at in the afternoon one day to the morning of the following day. Okay. So let me stop sharing my screen there. I'll come back to the option alpha side here. Okay, there we go. So what we're going to do is we're actually going to look at this template that's in the community. This is a template that Jack shared that was based on this same research. It's called Wi-Fi 1 DT $60 wide. Now, this one's a little bit different. I'll kind of go through what we're doing here on this template. But as always, you can get a copy of this template by just jumping straight into the community. You can research. Oh, I didn't share my tab there. There we go. This is the template here. That's based on this research, at least one that you can use as like a framework to start trading with it. You, of course, do your own research on what you want to do. But this is a really good one because it gives you a lot of the basic groundwork of how you can take this information and then start to apply it to an actual trading strategy. So a lot of people have already commented on it. There have been a number of revisions to it. People are posting their P&Ls on it. It's really cool. You can grab it inside the community anytime you want. So what I'm going to do is I'm going to go in here. I'm going to grab this. We'll just stick it in my paper trading account for now, give it some capital to allocate to, and then we'll go in and make some changes or edits to it. So it's very simple to update and clone this bot template, okay? So the way that Jack is running this template first is he's running this as a scanner only 12 o'clock and after. So if you remember from the research before, if you went 12 o'clock and after for the next trading day, the way that I'm going to do it right now, it's still over a 55% chance that the market is within $20 of that 12 o'clock range. So you could run it later in the day. You could run it starting at 1 o'clock or 2 o'clock. The later you run it in the day, you do kind of run into potentially not an issue, but just this idea that if you run it later in the day where there's a lot of decay already starting to happen in those contracts, or a lot more decay, it's not going to be a ton of decay, but a lot more decay than earlier in the day, then you run the risk of trying to get into a position where just the premium isn't there yet, and you're just not taking enough risk. So you might need to make it somewhere kind of midday to make that trade. So what I'm going to do first of all is I'm going to go in here and I'm going to run this on times that are actually about 1 o'clock and after. So 12 might be a little bit early for me. I like the idea of running it a little bit later in the afternoon. So I'll do 1 o'clock and after. So this scanner, even though it will be turned on inside of the bot, it won't actually kick in and run until 1 p.m. or later. It will skip over market holidays. And then the other thing that you could do, and I've seen a lot of other people do this also, is skip Fridays. If you don't necessarily want to trade over a weekend, you could remove the Friday from the days to run, which is what I'm going to do here. So I don't necessarily care to make this trade Friday afternoon to Monday morning because a lot can happen over the weekend. a lot can happen even during a regular day, let's be honest, right? But I don't want to take that extra risk of an entire weekend and something happening, right? So I would rather just trade them like Monday to Tuesday, Tuesday to Wednesday, Wednesday to Thursday, and that's it, right? I can skip Friday and I can go the next week because I'll have my other zero DTE bots going as well. So in this case, you can do a Monday, Tuesday, Wednesday, and Thursday. The symbol you want is definitely SPX because that's what we're going to be trading. If you wanted to set a maximum VIX, the way that Jack has it kind of, built out in his is that there's a maximum VIX level that kind of turns it off if volatility goes crazy. I would probably set mine a little bit higher. I'm not necessarily opposed to it being 30 or 25 or whatever, but there is going to be a threshold where I say, look, the VIX is just too high. Market volatility is crazy. You don't want to do that because we already know, and we've done research, I think we even talked about it in this show before, that volatility kind of begets volatility, and it's a compounding thing. So if you get a really volatile day, then you're going to likely have a very volatile day the next day. So we see that kind of built into the template in one way here and another way someplace else. So I'm going to go ahead and make those changes. I'll save them here. You can see those are updated here. So it's going to be running 1 p.m. or later, Monday, Tuesday, Wednesday, and Thursday only. So inside of the actual automation itself, here is what we have. The first thing that we have is we have this decision to see if the bot can open a new position. This is where you're going to put all of your decision criteria just to even allow the bot to attempt to open a new position. You could break this out into different decisions if you want to. You can add them as a group decision here. So in here, we said, can the bot open a new position? Like, does he even have room to open a new position? So it's not managing its other position from before. Does the market close at 4 p.m.? So it's a full trading day, which is what we want. It's not a half day or a market holiday. It's not an FOMC meeting today. There's no FOMC meeting scheduled in another day. So we don't want to trade into an FOMC meeting the next day. And we don't have CPI scheduled in one market day also. And we don't have to worry about CPI today because that would have been before the market opens. So it would have been done and off the books and out of here. We don't have to worry about it. So we're only checking for Fed meeting today, Fed meeting tomorrow, or CPI is scheduled in one day. So those are kind of broad level checks that you can do. Inside of here, what he did here is he also checked for the VIX is below your maximum VIX setting that we set, which I set mine at 30. And we're checking to see if the symbol change is less than 5% since the previous close in either direction. So basically, we're checking to see, did the market have, you could call it, it's not an inside day because that's not like the technical term for it, but you could say it had a low volatility day or lower volatility day. So the idea here is that if you're checking to see not only is the VIX low today, but yesterday's change to today, we're not starting the day with a 2% move, right? We're not starting the day with a 1% move, because if we are, then that means that we might get some bigger moves the next day and the next day, right? We know that volatility begets volatility in both directions. So we're looking for a day that is generally pretty neutral, pretty range bound, because it's more likely that we're going to have that type of day the next day also. So you can kind of put that in here as these tolerances. You could turn these into inputs if you want to, but I think just keeping them in here is totally fine. The next thing that we're doing here is we're opening up an iron butterfly position. We're going to open it for 1 day to expiration. So again, this gets us the next trading day, which is what this overnight range is based on. And then what we see down here is we're basically telling the bot exactly what strikes to pick. Now, this is a little bit different because what we're going to do is we're going to tell the bot, okay, this is the actual position you're looking for, but only get into it if you can collect a certain amount of premium or you get a certain risk reward that you're reward to risk ratio that you're looking for, which is a little bit different than using trade ideas. You could certainly, in many cases, use trade ideas if you wanted to, but we know that we want to get into a nice, big, wide iron butterfly position. And that iron butterfly position we ideally want to have is about $20 of break even on either side. So you're looking at a position that's going to be collecting about $20 of premium overall, which means that we should probably get into a position which has about $30 of wings on either side. So let me actually just get out of this really quick, just to kind of show you what I mean by this. So if we go here to positions, I'll go grab a new position. We'll say SPX. We'll go to iron butterfly and we'll select 1 day to expiration. Now we'll set the short strikes first. These are going to be closest to where the stock is trading. So we'll do 57.20. which is here. And then on the long wings, this is where we're going to go out about $30. So you're going to go down to about 56.90. That's $30 out from the short strike. And then on the top side, you're going to go up to 57.50. Now, if I do this, and this is actually good, I didn't know it was going to price out exactly like this, but you can see that what it's pricing out to right now, kind of mid-price for this trade, is about $20. So this means that you're collecting a $2,000 premium. Now, that doesn't mean we're going to keep all that premium. You might use exit options to capture a percentage of that, 15%, 20%, something like that. But what we're trying to do is we're trying to get outside that $20 range, because remember from our research here, let me stop sharing this screen. Can I switch back to the other one here really quick? Because I feel like this is an important part. Okay, so remember here inside of our opening range research, what we're looking at is we're looking at opening a position 1 p.m. and further, and we've got over a 55, 58, almost 60% chance that SPX is within $20 by 10 a.m. the next day. So that's really good information. Again, within $20 by 11 a.m., even if we go to 11 a.m., still roughly the same like numbers. So by 11 o'clock, you're still in that same range. It's not really till you get to 12 o'clock do those numbers start to decrease, especially if you open a position at 1 o'clock. It just gives you a little bit more time for the market to move that day and then the next day, right? But you're still like right above that 50% chance of landing inside that zone in the $20 range either direction. So if we take that $20 range either direction, let me switch back here. I know, guys, on the back end, I'm switching all over the place. Okay, you got me up there? Awesome. All right, so if we take this now and we look at this kind of mock position that I just kind of put together here, it's trading, entering an iron butterfly right at where the market is trading. So 57.20, expiration is 1 day to expiration, which is great. And the premium it's collecting is $20.15, which means that the break evens are about $20 away. That's what we're looking for. We're looking for break evens that are about $20 away on either end. So you get kind of like a nice $40 range. But in order to capture that $20 premium, to get outside that $20 range, you got to go about $30 out on either end. Now, if you wanted to capture more premium, you'd have to go even further out on these ends. So if we move these out here, another big grouping. So what is this? If we move this out to, that would be $50 on that side. And you're looking at, let's go out $50 on this side. Okay, so now you're going out $50. Now you're still about 1 for 1, reward to risk ratio, but now you're taking in $25. So if you wanted to capture a bigger range in that opening range data, it is going to require more capital because you're going to have to buy those further out wings, which are going to be cheaper, so that your net difference that you're capturing is somewhere around that width that you're trying to, that window you're trying to capture, $20, $30, whatever. I think that somewhere in the $15 to $20 range is probably more appropriate. Even if you do the $10 range and then try to hold it, further out, it might make sense if you can capture a really, really high premium and get that reward to risk ratio in there. But somewhere in the $15 to $20 range seems to be pretty appropriate because you can capture some good money and it doesn't cost an insane amount to do it. So let me just reset these back here. So all you have to do is go to your long puts, and we're going to reset these at $30, which is here. And then we're going to reset these at $50, which is here. Did I do that right? Oh, no, I'm sorry. I reset this a little bit higher. So we're going to set those at $30 and set these at $30. So that gives us, again, still about $20 of premium. The reward to risk ratio is just about 200%, a little over 200%, which is good. So it's going to be an expensive trade. But again, if we get these trades and they hit, 50, 55% of the time, that still should be pretty decent trading to get us into a good risk or a good edged position that we can use based on this new data. Okay. So that's what we're looking at here. So again, I'll take this off. We'll go back to our automation, go back in here and open up our open position action. So this is where we get the short put. We're just going to set that short put at just a penny above the underlying price. That'll kind of default to the next strike, whatever the closest strike is. We set our short call as the same strike as the short put. That's how we match up those two strikes for our iron butterfly. And then what we do is we set our long put leg to be $30 below and our long call leg to be $30 above. And so that's how we get those further out ends that we're going for. Now, the key here is that we're going to go down here in our position criteria, and we're going to ensure that the risk reward ratio, or the reward risk ratio that we're going to get, is over 200%. So if we find a trade that's $30 on either side, right? But the premium we're collecting is only $10. Well, that doesn't satisfy for what we're trying to get after, right? We're trying to get a $20 range for the next morning. And so what we need a premium that encapsulates that $20 range that we're going after. And this is one way that you can do it. You can also do the mid price is something like this. You could do the mid price is something between $2, and you could probably do it really high on this end, like $2.99, right? So you want to get into something that has at least a mid price of $2 to $3. I mean, if you get $3, that'd be amazing. Probably be really high volatility, but no less than 200% reward to risk ratio. So you can set both of those. They both have to qualify. I'll do that in mind here if you wanted to, but this is a really good way that you can, again, just ensure that you're collecting enough premium to make the trade. So once we do that, that position's in there. Again, all that criteria is saved in there. So all we need to do now is just essentially just turn on the automation, start letting it run. It does have some position inputs or bot level inputs. We did limit it to one contract at a time. So we're not going to get into a scaled position or anything like that. Those are big enough positions all by itself. And then also we have our exit options here that you can set. You can set profit taking at 15% of credit, or you can set it at 20%. I think I've seen some people do 25%, but it might be really high to take 25%. Some people have also set it at 15. I kind of like somewhere in between, like 20% of credit. You can use fast, smart pricing because you do want to get that pricing off really, really quickly. If you are trading in a small account, you do want to check this box here to wait at least one day to avoid pattern day trading. And what this is going to do is this is going to ensure that if you do get into a position, say at 1 o'clock exactly, or 1:02 in the afternoon, you don't want to get out of the position. Even though you might have a profit, you don't want to take that position off because you're going to get hit as a pattern day trader. You're going to get into a position at 1 o'clock and then say you exit at 3 o'clock the same day. So if you are trading in a small account, which is going to be a tough trade for a small account anyway, then you want to check this box to make sure that you're not going to enable any pattern day trading. And this will ensure that it waits at least until the next market day to start to exit the position. But if you're trading in a bigger account, you can uncheck that box if you want to, because let's say you get into a trade at 1 o'clock. By the end of the day, it could actually reach a 20% profit with some decay and whatever the case is if the market's still right there. So if you find yourself in that situation where you do get some decay by the end of the day, maybe you do have a profit, go ahead, take that profit, right? It doesn't matter to be a day trader or not at that point if you're trading a larger account. But at least you can wait until the next day if you want to avoid the pattern day trading. So that's what you do here. And then once you're good to go, you simply just turn on the automations, let the bot run through its process and go through everything. You can turn on to 1-minute scans, which are free for everyone now. And that allows the bot to kind of do what it needs to do to try to find a position and try to get into that position for you. So I hope this was really helpful kind of going through this. Again, all of this information is going to be inside of our overnight range area inside of the OA Labs research section. You can download this Excel file. It's literally updated every single day. So as we just get more data and the market starts to move, we just continuously update this moving forward. But it's really cool because I think what you can do with it is you can start to trade a little bit more, aggressively on the next day to expiration options too, if you wanted to. It's not for the faint of heart by any chance, but it is something that you can do where volatility is generally dried up and you see these short, tight, narrow ranges. Well, now you have a trading strategy I hope that you can start to deploy to start to take advantage of these days where we don't get a lot of normal volatility in the market and profit from the ranges, which are pretty tight and narrow. So I hope you guys enjoy this. As always, if you have any questions, let us know. Thank you so much for tuning in today, and we'll see you on the next show.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.